Signal episode 23, we decoded pharmaceuticals and healthcare, a sector defined by scale, science and trust, and why it remains essential and outcome-driven for investors. Today, in Signal episode 24, let's explore real estate, a sector that is often misunderstood because it is tracked through prices rather than execution quality and delivery discipline. So let's unpack all this in Strategy of the Week, followed by Story of the Week with a fun fact, review market highlights, and conclude with a powerful quote of the week. Signal and I will be taking a brief pause and will be back with you on 8th of February 2026. Welcome back to Signal, where noisy markets meet simple, sharp and sound insights for long-term investors. Real estate sits at a unique point in the economic cycle. It reflects the confidence of buyers, lenders and developers coming together. When these three align, activities sustain and balance sheets strengthen. Real estate fits best as a measured allocation within a diversified portfolio. Its role is to confirm economic strength, stability, and participate in long duration growth rather than generating rapid momentum-led returns. So how can investors actually participate? Direct property investment is the most conventional and familiar route. Investors buy a physical property, receive rental income, and benefit from long-term capital appreciation. Returns depend on the type of property bought, location, and how well the property is managed over time. Best suited for investors who value control, are comfortable with concentration risk, and have the time to manage the property. Listed real estate companies and REITs allow investors to participate through markets. Investors get exposure to professionally managed property portfolios across commercial offices, shopping centers, residential developments, and specialized assets with liquidity and income visibility. Best suited for investors who want professional real estate exposure, value diversification across various types of real estate, are comfortable delegating professional management, and prefer flexibility. Mutual funds with real estate exposure is the simplest and most flexible way to participate in real estate. Investors gain exposure to real estate linked businesses through professional fund management without having the need to buy physical properties and needing large upfront investment. In fact, this could be the most practical way of starting to build towards your future home deposit. Best suited for beginners and wealth accumulators who want simplicity, flexibility, diversification, professional fund management, and either can or prefer to start with small amount of investments. For Story of the Week, let's meet Rohit and Anita, 35-year-old professionals and at similar stages of their financial journey. Rohit chooses direct property investment. He manages tenants, vacancy periods, maintenance, and remains exposed to interest rate movements. His outcomes are dictated by property prices and the time he commits. Rohit benefits by having full control and concentrated upside with returns linked to a single asset. Anita, on the other hand, invests through listed real estate companies and REITs. She gets exposure to diversified mix of real estate assets like commercial offices, retail centers, wholesale and logistic parks, residential developments, and specialized assets like data centers and industrial parks. This participation comes with professional management, predictable cash flows, and the flexibility of liquidity without day-to-day involvement. Her returns reflect portfolio level performance rather than being tied to a single property. Now pause and ask yourself, do you prefer full control, knowing the fact that your investment's outcome is dependent on one asset? If it rises, you gain. If it declines, you lose. Or do you prefer delegating control, allowing professionals to manage assets on your behalf and giving you access to diversified mix of real estate assets, which otherwise would be impossible for you to participate with small savings or investments? There is only one right answer, the one that aligns with your time, temperament, and life stage. And on a lighter note, real estate assets doesn't just test your capital, it tests your patience, availability, and WhatsApp notifications. It's one of the assets where investors become plumbers, electricians, and negotiators overnight. For the week ending 16th January 2026, Indian stock markets saw mixed action. Early weakness from persistent tariff concerns and foreign outflows gave way to a late week rebound. This rebound was led by strong IT earnings, which lifted sentiment across broader indices. Sector performance reflected caution and selectivity. Technology and quality large caps held better, while rate-sensitive and trade-linked sectors remained under pressure. Foreign institutional investors remained cautious, while domestic institutional investors continued to provide measured support. The rupee continued to remain under pressure, reflecting firm US dollar and elevated global yields, though volatility stayed orderly. Overall, it was a week of consolidation and reset that rewarded patience and portfolio discipline rather than reactive positioning. So today, for quote of the week, let me leave you with a reflection. Real estate is slow until you realize that slow is the feature. We are building a strong community of reflective, receptive, and resilient long-term investors. If you're one of them, why not like and subscribe us and tell us in comments. In 2026, when it comes to real estate, would you choose diversified portfolio or direct property?